And once again, we want to welcome everybody to tonight's call, The Financial Aspects of Dental Practice Transitions, presented by Monica Rebella, CPA, IAR of Rebella Accountancy, and Arthur S. Wiederman, Dental Practice Broker with Wiederman and Potter Premium Practice Sales. On the confirmation and reminder emails you received for the call tonight, there is a link to the webinar simulcast where we will be showing the slides for tonight's presentation. If you click on that link, it will take you online to our webinar page, and in the upper left-hand corner, you can click on the slides button. That's the slides button. And the slides will load, and then you can synchronize them with either the phone line, if you've dialed in tonight, or on the webcast online if you're listening on your computer speakers. If you have a question and you are online, you can ask a question in the box at the bottom of the page, or we will be opening the phone lines at the end of the call, and you're welcome to ask questions then. And again, this is The Financial Aspects of Dental Practice Transitions, presented by Monica Rebella, CPA, IAR, and President of Rebella Accountancy. And we're talking also with Arthur Wiederman, Dental Practice Broker with Wiederman Potter Premium Practice Sales. I see it's at the bottom of the hour, so let's go ahead and get started. Art and Monica, welcome to the call.
Thank you, Jeff. Thank you, doctors, for being here tonight. I know that it's late. You're just finished your long day, so I appreciate your time here after hours to listen to our conversation. And it will be a conversation tonight. What we want to accomplish tonight for you is to give you some practical information for those of you that are looking to sell your practices in the next 2 to 5 years, something that you can really think about now as you're getting ready towards looking to sell your practice and what things are happening now. We're on slide 3, and we're looking at what we're going to cover tonight. We're going to talk about a case study. Are you ready to get there? Are you ready to retire? We're going to talk about the general atmosphere, where it stands right now in the sales and in transitioning of practices, valuation in today's markets, and how is that being determined. We're going to talk about practical things. Do you tell your staff that you're selling, and when might you tell your staff? We're going to talk about working with brokers. Some of you would like to do that, don't like to do that, so we're going to talk about why it would make sense to do that. We're also going to look at what makes your practice the most valuable. Who's going to get the most for the practice, and how does that happen? Your practice profitability, what are the buyers looking for, and what are the people that are analyzing it looking for in your practice? Your lease, tax aspects, and if we have time, we're going to look at another case study and a couple other things. But we want to make sure we get to your questions. So if we run out of time, we won't cover some of the slides at the end, but we're going to cover as much as we can tonight. But we want to focus on key things for you. So we're going to go to slide 4. Are you ready to retire? So we've kind of picked middle-of-the-road doctor here, where he might be thinking about, or she might be thinking about retiring, selling the practice. So we've picked someone that's 65 years old, and his children are no longer on the payroll, right? They've gone on to college. They've got their own jobs. They're no longer working with your practice. That you own the dental building. I'm sorry, you do not own your dental building in this scenario. You produced about $800,000 a year, and your profit's about $280,000 a year. Okay, and you've got a pension plan contribution of $60,000 a year, so you're netting $220,000 that's coming to you a year. You've got $30,000 of expenses that the buyer is going to say, gee, are these reoccurring expenses for me? So we got to look at those. You saved $1.8 million in your retirement plan. So your retirement plan's doing pretty well. Your house is worth $1.2 million, and you owe $200,000 still on it with a payment of $2,500. He's looking for $600,000 for the sale of the practice. It's in a great location. It's in great shape. They've got receivables. And they think that the doctor here in this case study, we're thinking that he's going to have about $400,000 left that he's going to get cash net after the practice, after taxes, et cetera. The doctor and his wife have $168,000 or $14,000 a month that they want to live on when they retire. So let's flip to page 5. So here's how it breaks down. And we're taking a conservative approach because you all know how the market is doing. He's got distributions in retirement from his retirement plan of about 4.5% a year on the $1.8 million. So that's giving him about $81,000 a year that he can get an income off of his retirement plan, taxable. He's got a Social Security income of $21,600 for himself and $14,400 for his wife. They've got income from their investments of another 10. So you can see their total income is about $127,000 a year, $127,000 a year. Well, the next one's going to get you. Remember, we talked about how much we think he needs to have in retirement, $144,000. But there were expenses in the practice that are now his personal expenses, and this can't be overlooked when you guys are getting ready to retire, of $30,000. So really, they need $174,000 a year in retirement to cover everything that they want to do in retirement. So right here, this should alert you to something's not right here. Let's go to page 6. My first point would be it's not time to retire. What you want to live on in retirement is not going to cover what you're going to be able to get off of your retirement flow of income. So we got to really talk about it. Is the right time to sell, the right time to retire? But let's say it is. Let's say you've just come to the point that you need to. How are we going to make up this shortage? Well, the shortage comes from maybe working part-time in retirement. You know, you might be able to work for someone else that wants to have someone come in part-time. They want to cut back. Cut back on those expenses in retirement. Maybe you don't need to have all of that in retirement. You could sell your home, move to a less expensive home in retirement. There's an option. You know, some doctors say the kids are gone, they're grown, they've married off. Do you need the big house anymore? Maybe you could be in a less expensive home. And the next is work a few more years and save. You know, potentially it's just not the right time when we actually look at the numbers. And I want to let you know that on My Dental CPA, my website, mydentalcpa.com, there is a webinar there that takes you through scenarios that I've seen with my clients on how much money do you need to retire. And you might want to go back and listen to that webinar because that's the place we really need to look at is where do you stand right now? Take a look at really where your finances are, your retirement plan is. Are you ready to retire, or do you have the retirement funds set up to have the life that you want when you retire? So we're going to move on to slide 7, and I'm going to turn it over to Art. We're going to talk about the general atmosphere for selling practices. So, Art, I turn it to you.
Thank you, Monica, and good evening, ladies and gentlemen. It's nice to have this opportunity to chat with you tonight, and I'm going to share as much information as I can, and hopefully it'll all be helpful in helping you plan out the next phase in your life. So let's start off by talking, again, we're on slide 7, general atmosphere for sales and transitions. I'm going to start with a little background. Back 3, 4, 5 years ago, when the economy was doing well and we didn't have any problems, a practice would go on the market at 9 o'clock on a Monday morning, and by 11:30 in the morning, we would have multiple full-price offers and practices being bid up to, in many cases, over 100% of gross receipts. I actually had heard of a situation with another broker where a practice was being listed for 180% of gross, which, as you'll see, is a little on the high side. But then we had this economic downturn that you all might have heard about. And what happened is that all these practices that sold at high prices that were too high, what happened was a lot of them started to fail. And the banks started taking hits. And the banks got a lot tougher in their evaluation of whether they were going to make loans to buyers to buy practices. You also had doctors who, when this economic downturn came, lost 10, 15, 20, 30, 40% in their 401ks. In fact, their 401ks became 201ks, unfortunately. And those practices didn't go on the market. So you have more buyers and fewer sellers. What does that mean? That means for the good practices now, it's a good time to sell your practices. Practice values, which we'll talk about in a minute, are still very, very good in Orange County. But the fewer practices means that higher prices for the good practice. If your practice is a good practice, and we're going to get into several slides that tells you what is a good practice as far as being able to sell it for a premium. Okay, we're going to get into that in a little bit in the next couple of slides. Banks are requiring more skin in the game. Many, many times we are seeing banks requiring a 10 and 20% infusion of a seller carryback. And you have to remember that if you as a seller carry back a note, that's pretty much an unsecured note because the bank is going to take a first security position in the practice for their loan. And if the buyer defaults, you're not going to get anything for your note. So I always tell folks is that, you're probably selling for what the bank's going to loan in this situation, and if the buyer pays you, that's gravy to you. But that's what we're seeing. Buyers are being a lot more detailed and skeptical. And you have to remember that now a buyer is going to go to a dental CPA, someone like a Monica Rebella, who's going to be looking at your numbers. They're going to be going to a dental attorney who's going to talk to them, and they're going to be talking to a lender. So you've got three different people who live in the dental world who are all going to say, hey, wait a minute, this, what about this, and this doesn't look right. So they're being a lot more detailed and a lot more skeptical because people are more nervous about the economy with everything that's going on and all the news coming out of Europe and all these things that we're hearing. So, it's getting harder to get these practices than it was 3, 4, 5 years ago. Because of the economic downturn, the good news for you as a seller is that you've got fewer associate jobs, which means that we're actually talking, we in our brokerage business talk to buyers all the time, and we're seeing buyers who were they were going to start a practice, but then they find out it costs $500,000 to start a practice. And they don't want to go $500,000 into debt because they're making good money as an associate and they can't afford the payments. They don't want to take the risk, and they can't find a job. So they're basically, they're having a difficult time. So there's more buyers out there to buy your practice. In my opinion, it's a good time to sell if you have a profitable practice. Okay, let's go ahead and move to slide number 8, valuations and practices in today's market. And let's kind of talk about, what's your practice worth? Because that's really what you want to know. How much am I going to get for my, 30, 35, 40 years worth of work in my career? Well, as a general rule, across the United States, and it's been this way for many, many years, dental practices cash flow correctly to sell at about 60 to 80% of the prior 12 months gross production, except in two places. One is New York City, and the other is Southern California. And why Southern California? Because everybody wants to live in Southern California. Were you folks out over Christmas week and New Year's Day? New Year's Day or January 2nd when the Rose Parade was going on, I think it was 82 degrees. Everybody wants to live in Southern California, so the values are higher here. In Northern California, it's about the same as it is in the rest of the country, 60 to 80%. Southern California, as I mentioned earlier, 3-4 years ago, we were seeing practices regularly going at over 100%. But right now, you're looking at 80 to 95% of gross. Another benchmark that we use is somewhere in the neighborhood of 2 to 2.5 times, more closer to 2.5, in some cases a little higher, of the true net profit of your practice. We use those two benchmarks in looking at evaluation of a practice. There's a lot of factors that go into valuation. It's almost like, you've heard about how you value real estate, location. Well, if you have a really good location in a city that's growing, has a high socioeconomic value, socioeconomic income, you're going to have a higher value. If you have equipment that is state-of-the-art equipment, and we'll talk about that in a little bit as to what goes into this, your practice is going to be worth more. And I don't think we have any specialists on the line tonight, but those specialties are on the slide. They're a little lower because you're selling more of a referral base than you are a base of clients. All right, let's go ahead and move on to page 9, and I'm going to talk about do we tell the staff that's selling? I'm going to turn this back to Monica.
Thanks, Art. So there's always this question. Do I tell my staff that I'm going to be selling the practice? And I will tell you overwhelmingly, no. You don't tell your staff that you're thinking about selling your practice. And the reason is you want to preserve the goodwill in your practice. You want to preserve your practice. If you start telling the staff you're thinking about selling, first they're going to freak out because they want to know if they're going to have their jobs or not. The second is they may tell patients. And if they tell patients, then you start losing production. Then you start losing goodwill in your practice. So I would say for the most part, no, you don't tell your staff you're thinking about selling your practice or even that you have listed it. Now, in saying that, there's a possibility that your staff could find out. Is if you tell your family, they may potentially say something inadvertently to someone in the office because some of the people in the office are like family and maybe they showed up at the holidays and something was said. And what you have to do is then tell your staff, because if someone found out, then you need to talk with them. And what you have to tell them is this is preserving the goodwill of the practice. If we don't have production and we don't have patients, we start losing them, I lose the goodwill, and if we don't have the patients and production, you could lose your job. So if they inadvertently find out, definitely you have to tell them, and you tell them the reason you didn't tell them was because you want to preserve the practice, preserve the patients and the revenue so that the buyer has that, and preserve their job. So it's important that you really don't tell them ahead of time, but if they do find out, be honest with them that you have to protect the practice, and it's important. So let's talk with our broker. Let's get some advice from Art.
Well, thank you, Monica. And this is a loaded slide number 10 that says working with brokers. Obviously, I have a bias towards that because I are one. But I have seen doctors try and sell their practices on their own. Let's think about what's necessary in a practice sale. You have two dentists who are both working. Because remember, your associate, your buyer, is working in a job. They're either working in another practice or as an associate or whatever. You have two attorneys. You have two accountants. You have a management consultant. You've got a bank. There's a lot of moving pieces. You also need to have a database of people who are going to buy your practice. Now, I will tell you, as a broker, if you have a practice and you have an associate working in that practice, you don't necessarily need a broker. A broker is good to facilitate that deal, and the brokers will do it at a lower commission if you bring the buyer to the table and say, this has been my 4-year associate, we've talked about it, and stuff like that. But generally, it's much easier when the broker does all the heavy lifting. So, we have access to all the professionals that are needed, and it's got a lot of legal and financial aspects. We're going to talk about the lease in a little bit, which is a huge deal. Very time-consuming, dozens of phone calls. And I will tell you, doctors, if you start making lots of phone calls and going into your office and going on your cell phone in the middle of patients, your staff is going to figure out that something is going on, and we've seen it happen. We have a huge database. Our database, I think, has about 3,000 buyers in there that we know we have a very sophisticated program that we use called Salesforce that's got all the buyers' names, what cities they're looking for, what size of a practice, and we can pull up. And if you say, I'm looking to sell a practice in the city of Orange and we do $600,000 a year, we have a bunch of folks that have told us that's in their top 3 picks. And again, it's just very, very time-consuming. Disadvantage: the standard commission is 10% of the sales price, but it's a lot of work, and it's very time-consuming. I would encourage you to work with a broker, and it's certainly something that we can talk about down the road. All right, let's move on to page number 11, and let's get into some of the things that are going to make your practice more valuable. The number one thing is high net profit. And when you look at the sale of any service business, and that could be Monica's practice, a law practice, an architecture practice, a dental practice, basically there are really no fixed assets to sell other than your equipment, which doesn't have as great a value as the goodwill. When you sell a practice, you're selling two things. You're selling the equipment, the furnishings, the computers, and you're selling the goodwill. The promise that when you sell this practice, that those 12 or 1,500 patients that have charts sitting up on the wall in your front office are going to go ahead and they're going to come to the buyer and they're going to continue to pay for Profies and crowns and bridges and inlays and onlays and all that stuff for the next 30 years to the buyer, and that's what they're really paying for. Modern equipment makes a difference, but I want to make a very special point. In fact, Monica and I were talking about this before the webinar. I will encourage you very, very strongly not to spend a lot of money a year or two before you sell your practice. Because you're not going to get it back. So you're going to say, well, listen, I've been talking to people, and they're telling me they got to have digital x-ray, and they've got to have CAD-CAM, and they've got to have lasers, and you're going to spend $200,000. You're not going to get it back. The practice is going to be valued based on what you're producing and what your net profit is. It's going to make it easier to sell because a lot of the buyers today, which is probably different than when many of you went to dental school. A lot of the buyers today are working with all of this new technologies. We see a lot of sellers. In fact, I was talking to a seller that we're going to be working with, and I go down the list, and he doesn't have any of the new technology, no CAD-CAM. He has one intraoral camera, no digital, no lasers, and guess what? He's been successful for 30 years, and so have you. So that's a big thing. But modern equipment and computers. I mean, if you're 5 to 10 years out, then you want to have that conversation with Monica from an economic standpoint as your CPA to be talking about that. But if you're a year away and to spend $200,000, $150,000, it makes no sense. Fee for service, including Delta Premier, and I want to make a comment about Delta. I'm sure you're all very well aware that things are changing at Delta Dental. If you were a new provider right now to go on to Delta Dental, you would have to take their PPO plan. And we have heard things that within the next 12 to 18 months, Delta Premier is going to be a dinosaur. And things are changing in that world. But the fee-for-service practice is going to be in general, a high-profit practice and the type of practice that dentists are looking to buy, as opposed to a practice that's PPO. I had a doctor come to me about a year ago. He's doing a $1,200,000 and he's netting $175,000. He's netting 15%. And I'm looking at this and saying, doctor, what's going on? And we kind of got into the, as we call it, into the mouth of the practice, and 70% of his practice was PPO, and he was averaging 50 to 70% of UCR fees. And I said, you're doing $1.8 million, $2 million worth of work, and you're getting paid 1.2, and his practice just isn't worth anywhere near what he had hoped. So that's another conversation to have as far as taking a look at the mix of your practice. Location. Doctors want to be in areas where people can pay for the dentistry. But I will tell you that there are many socioeconomic areas where the median income is lower, where you have hardworking, honest people who will pay, and that might be a good place for an HMO practice if that's what you have. So it's all about having that conversation. New patient flow. The buyer's going to want to say, how many new patients are you getting? Well, we don't really do any marketing. Well, that's good and that's bad. We don't do any marketing, but the fact is, if you're only getting 3 or 4 new patients, then you're doing all the work on those patients. What is there left for the buyer? If you're getting 30 or 40 new patients a month, and we see that, and you're only producing $600,000 or $700,000 a year, that buyer is going to look at it and say, listen, we're getting a lot of new patients, and there's a lot of work to do. Larger number of active patients. I had one of the dental attorneys tell me, but this is the number one source of lawsuits. And I will tell you that in many, many practices that we look at, when the management consultants go in and look at the reports, they say garbage in, garbage out. We don't see accurate numbers. An active patient is generally defined in one of two ways, either someone that's been in the office in the last 12 to 18 months or 18 to 24 months. We usually use 18 months as a benchmark. And so if someone tells us, we're doing $800,000 and we have 4,000 active patients, no, they don't. Most of the practices we work with have somewhere between 500 and 2,000 active patients, depending on the size. Good mix of procedures, age of patients. Here's something that's attractive. You got to remember that dentists coming out of school today, they are doing all the procedures that you may not be doing. They're doing their own endo. They're placing their own implants. They're not just doing the restorations. They're placing implants. They're doing ortho. They're doing phase 1, phase 2 ortho. They're doing Invisalign. They're doing all these procedures. They're doing, some of them are doing full perio. So if you're not doing all of these, a buyer can look at this and say, hey, wait a minute. I can do, this. You refer out 10 endos a month. Well, that's $10,000 a month. That could make their loan payment. So that's something that we want to take a look at. Let's go ahead and flip to page 12. We're going to continue. And Monica, go ahead and chime in on some of this as you see fit. You want to look at your production and procedure analysis. What kind of practice do we have? Do we have operative versus restorative? We sold a practice about 3 years ago where the practice was right next to an Army base, and that was the town that they were in. And 95% of the patients came from that Army base, and they all had insurance. And their insurance didn't cover crowns at all. So guess what? This doctor was doing amalgams and composite restorations all day long, and that's the type of practice. Well, is that what a buyer wants to buy? It all depends on what your mix is. We're looking for a good mix of crown and bridge and restorative. The other thing is, if you have a practice where you're virtually a prosthodontist and you're doing big cases and $30,000, $40,000 cases, and you've taken advanced training, you're a Kois mentor or a Spears mentor, and then you've kind of limited the people that could buy your practice, because a young man or a young woman 1 or 2 or 3 years out of school isn't going to be able to handle your practice. You want to look at your uncompleted treatment plan reports. For you in operating your practice, and I'm sure Monica talks to you about that, as your CPA, lower is better because we want you to do more work. But if you have a big uncompleted treatment plan report and you've had trouble presenting cases, and we hear that a lot from sellers, they've been having trouble getting cases sold to patients, then that's better for a buyer because there's more work for that buyer to do. The hygiene department, huge. The hygiene is going to be a big source of lawsuits in the next coming years. Failure to diagnose periodontal disease and the link between periodontal disease and heart disease. There was a big article you might check on the Wall Street Journal a couple weeks ago about that, I think in late December, about the link between periodontal disease and a lot of afflictions that are out there. And again, PPO, HMO, and if any of you have HMO plans, those are some of the most profitable dental practice I've seen. If you know how to run an HMO practice, you can do very, very well. So again, it just depends on what you have there. Go ahead, Monica.
Let's talk a little bit. There's some doctors that do their own hygiene, and there's some doctors that have hygienists. So if a buyer is looking for a practice, what makes more sense to a buyer? Are they looking for one where the doctor is doing hygiene or is not, or is that an opportunity for them if the doctor's doing it?
Well, if the doctor's doing the hygiene, that probably means that it's a low-producing practice. And, the doctors don't go to dental school to do hygiene. That's generally what the hygienists do. And a doctor's much more productive. We want the doctor producing $600, $700, $800, $900 an hour, if possible, as opposed to producing $100 an hour. But if the practice is small, a lot of doctors who start out and who are building out an office, they have to do their own hygiene because they can't afford a hygienist. But in most cases, we're going to want the doctor to be doing no hygiene. But when they buy the practice, if it's a small $200,000-$300,000 practice, that gives them a great opportunity. And I like the smaller practices too, Monica, for a buyer. I like the small practices because you can grow them. The other thing is that the goodwill is generally held by the hygienist, and the hygienist does have a lot of allegiance, because what happens is that most times they spend the majority of their time with the hygienist unless they're having a procedure done by the doctor. So it's good to have a hygienist because they hold a lot of the goodwill in the practice. Hygienists do three things in a practice. They sell your dentistry, they're a source for referrals, and they're a revenue, a place for revenues. So there's a great place for hygienists in dental practices. Okay, let's go ahead and flip over to page number 13. And let's kind of talk a little bit about what they're looking at as far as the overhead and expenses. And again, Monica, you're the CPA, you're the numbers person here, so go ahead and jump in on that.
I'm going to jump in here because I do look at a lot of dental practices for potential buyers, and it gives me a good feel when I'm doing this as to when I'm looking at your practices, what makes sense here. So when the buyers are looking at this, when they've got a CPA that specializes in the dental practices, we look at staff salaries and benefits. And the reason we look for that is, the buyer needs to know, what are these people making? Does that make sense? And what are they on the hook for benefits going forward? And are these salaries make sense? I mean, I have seen some where, you've got an office manager that makes, quite a bit of money, and they have to find, is that office manager really worth that? Are they the continuity? Are they the goodwill there? Are they helping sell the dentistry? Does that make sense? So definitely looking at salaries and benefits is important to the buyer, because they're going to be taking that over. They'll have a good due diligent person and a consultant to go in there and evaluate the staff, make sure that indeed that's the staff that they want to keep, because in some instances, the doctor just hasn't gotten around to being the bad guy and gotten rid of someone that's really not pulling their weight, and you need to know that, whether this is the staff that you want to have. The next is lab and supply expenses. Well, I pretty much know where those should be by percentages for your practice and what kind of a practice you have. So when I see those outside the ranges, I always have to ask. I had one dentist who had a CEREC machine, and I knew she used the CEREC machine religiously. She did not use a lab. And so when I looked at her numbers and saw lab expenses, and I've seen this for some sellers, I asked, what's in lab, because you've got a CEREC machine. How much are you using that, and how much aren't you using the CEREC machine? So it's something to ask. And then your supplies expenses. Keeping those within range makes sense, not only for you, because I want money in your pockets, but also for the buyer. Advertising. And I'm going to let Art talk a little bit about advertising as well, but I've talked to you for a lot of years talking about the best type of advertising is internal. If you're doing a good job for your patients, ask them. Let them know that you're looking for more patients, you want to grow. Your patients don't know that you want more patients. You've got to ask them. But if you are advertising, you want to get your bang for your buck. So if you've just spent $40,000, $50,000 on advertising, what was it, and have you tracked it, and is it really bringing something to you? I will tell you right now, I've got doctors that are looking on Groupon. Overall, I don't like Groupon, but I've got a couple of doctors that are using Groupon, and they are actually converting 100% of every patient that comes in there for that $39 pro fee. Now, you've got to have a good practice that does that, but you're going to pay money. They tell us that they've got 5 people in line for every person that turns it down. So they're telling us that it's going up and up as to that. So you've got to look as to what you're spending your money on. Advertising, what do you think, Art?
Well, you're absolutely right, Monica, at the internal marketing. And I will tell you, I talk to dentists all day long. Sellers are selling their practices. And I'll ask them, I say, well, do you ask for referrals? And the answer I always get is, well, not as much as I should. Well, that means you're not asking for referrals. And it's very hard for we as professionals, I'm a professional broker, Monica's a CPA, you folks are dentists, to ask for referrals, to advertise. We're not trained that way, but you have to do that because, again, as Monica said, patients don't know that you're looking for new patients. Also, Facebook is huge. Social networking is huge. And, in fact, statistics show that the largest growing faction of people coming on Facebook are people ages 50, 55, and older. And why is that? Because that's how they keep in touch with their grandchildren. And what are those patients, 50, 55, 60? They're patients that need implants and restorative and cosmetics and all this kind of stuff. So advertising is huge. Not a big Yellow Page fan. Yellow Pages are a dinosaur. It's how, when I started out a long time ago, that's what I'd look for, but now the Yellow Pages are a dinosaur. But, the internal marketing, and that's still, even with all the social networking, the internal marketing is absolutely where it is.
Great. Well, we're going to talk about office rent here in a moment, so I'm going to pass on that because there really is some key things. But I will tell you, if you're downtown L.A., you're going to be paying a bunch of rent, and that's by location. If you're in New York, you're going to be paying a bunch of rent. But we'll talk about that. The biggest is your lease and what you've got left on your lease. I want to focus on slide 13 at the bottom. It's time to clean up your profit and loss statement. If you're looking to sell in the next 3 years, it's time to make it squeaky clean. You need to make sure your bottom line shows good profit. So as much as it hurts me, it pains me, I can't tell you how much for me to say this.
Monica's shaking right now. I can see. She's just shaking.
You may have to pay
We might have to call a doctor in for Monica right now.
You may have to pay a little extra tax, and we can talk about that, but we want you to get absolutely the best price for your practice. So I would say, 2 to 3 years, we got to look at making sure your profitability looks great. Let's go to slide 14. Now we're into office lease, and, this is where Art really needs to chat with you about the lease. So, Art?
Well, I will tell you, folks, and look at the first slide, the first comment on the first slide. It's underlined and in bold and for a reason. If you don't take anything from what we're talking about tonight, if you are 1, 2, 3, 5 years away, what you need to do is you need to get on the phone with a dental attorney, and Monica can give you referrals of the ones that she works with as your CPA, and you need to send them your lease and spend some money and let them take a look at it. I'm going to tell you a horror story right now on a deal that we closed today. And here's what happened. The doctor's practice was doing great. We found 2 very high net worth buyers who were doing very, very well. They were buying it, and they're going to not only take what this guy is doing and turn it into a multi-specialty. They got all these plans. And we begged when we took the listing. We begged this seller to go and have the lease looked at. Let's see what we can do. It had about 2 years, 8 months left on it with no options. So normally when we don't go to the landlord till the end, because landlords don't like change. They have their people, and they're looking at a new buyer and all that stuff. So we went to the landlord right, as we had gotten the buyers approved and everything like that. We go to the landlord, and the landlord says, well, we'll give you a new lease, buyer, even though you have a high net worth, but we want the seller to stay on the lease for 7 years. The rent was about $8,500 a month. So that's $700,000 that potentially that seller could be liable for if the buyer walked away from the practice. And generally, the banks will not lend unless you have at least 5 years on the lease. So the landlord said, well, and the tenant, the seller, who's been there a long time, says, well, wait a minute, that's not fair. I want to be off lease. And then the landlord says, fine. It'll cost you $100,000. So with some very, very, very outstanding work that my partner got involved in, and working with the bank and doing this, we were able, and I'm going to put this and say this is an isolated incident. We were able to get the bank, because of the fact they may move the practice, we got the bank to go ahead and make the loan with 2.8 years left, 2 years, 8 months left, and basically we saved the $100,000 and the deal closed. But I'm going to tell you, landlords are very, very difficult these days. I don't care what kind of economy it is. You have got to be prepared. You've got to have options on your lease. You've got to have, some of these things. There's war stories. I could spend an hour on war stories. I wish I had the time. A couple of things you want to look at in your lease is a recapture clause. A recapture clause is something that says you're in a shopping center and you're a dental office and now you're going to sell. You tell the landlord you're going to sell. The landlord has an opportunity to say, well, you know what? We already have two other dentists in the center. I really want to sell this to I want a Whole Foods market in that space. It's a perfect space. So we're going to recapture your space, which means that you can't sell your practice to another dentist because the landlord takes it back. Those clauses are in leases. Your clause needs to be able to be assumed and assigned over to a buyer. And you want to, if possible, have a clause in there that allows you to be excused if that happens. Because the landlord, in this case, my seller, is going to be on the lease for 2 years, 8 months more, and he knew that. But he's still liable on that lease. And if the buyer walks away, they're going to come to him for $8,500 a month of rent. There are actually clauses in leases that allow a landlord to receive a portion of the practice sales proceeds. Yes, they do exist. It's 50, 75%. And one other thing that's not on the slide that you might want to make a note of, you want to make sure that the options are not personal to you as the lessee, because if they are, those options cannot be assigned to someone else. So you don't want them to be personal. the best thing that I can tell you to do is absolutely, again, if you don't take anything from what we're talking about tonight, the best thing that we can do is to go to a dental attorney, send them a copy of your lease, say, I'm ready. Hi, I'm Dr. Jones, and I'm a CPA client of Monica Ribella's, and I'm looking at selling my practice in a couple of years, and I need you to look at my lease and just make sure, where am I at, where are the landmines, what am I going to do? The rest of it is not hard, but the landlord is something that we as brokers, we just don't control. Okay, now we're going to go to page 15, and we're doing taxes, and that's not what I do, so that's what Monica does. We're going to let her talk about what's the tax ramifications of selling a practice, page 15.
Thanks, Art. Yep, here we get into the fun of it, right? Fun of it for me is, how do we determine what you're going to get taxed on, and how do we work around potentially, making that tax bill a little bit less for you. So, you sell basically 5 things when you sell a dental practice. You sell equipment, you sell supplies, you sell covenant not to compete, you sell goodwill, and you sell your patient list, right? That's what you sell. You got 5 things you sell. So what we look at is the total price. So when you get a broker, you get the attorney, and they say, what does your CPA want the allocation of the selling price to be? This is what they mean. And we get a little bit of fun here as to how do we break up the total dollars into different categories. I want the best for you, my client that's selling it, so that you can pay the least amount of tax. And when I look at that, here's where it is, goodwill. Goodwill for you at least till this year, the end of 2012, because all bets are off come 2013. But at least through this year, goodwill is still at the 15% long-term capital gains rate, right? So you get a tax break right there. So what I would like is 100% of the sales price to be goodwill. That would be my favorite scenario in the entire world for you, because you get that long-term capital gains rate. But the reality is, the buyer needs something, and we're trying to be equitable between the buyer and the seller. We'd want both of you to have a win scenario. Of course, I would like you to win a little bit more. So the dental equipment, furnishings, etc., there's a note here. It says subject to recapture. Okay, what recapture means is, if you've had your equipment a while, and many doctors that are selling their practices have had their equipment a while, you've taken all those wonderful depreciation dollars on it for tax deductions. Well, whatever dollars we then allocate from the sales price to that equipment is not capital gains. It's regular income, as if you had just had production and collections from your patients. So you're going to get hit at your top tax brackets on that, which is around 43-44% tax brackets, which is California and federal combined. Not my favorite category, as you can imagine, but it certainly gives a good deduction for the buyer. They need write-offs as they're paying their loans off in the next 5 to 7 years. Supplies are in the same category. They're going to be at your tops rate, because these are expenses you already took. So if you took the expenses, then it's income, just ordinary income to you. Covenant not to compete, that comes out to you personally, where the equipment and the supplies are in your corporation if you're incorporated. The covenant not to compete typically comes out to you personally, because it's you not to compete with the buying doctor, not your corporation to not compete necessarily. Albeit, there is a strange court case out there, and it'll be something when you get ready to sell we'll talk about. I don't think I have many clients in there. Of course, goodwill, my favorite category for sellers. But for buyers, it's really a terrible category. They have to take this over 15 years on a straight basis. So, there's always this pull and tug, and this is where the buyers don't like goodwill. But the reality is, most of what you sell in your practice is goodwill. I mean, that's the majority of what is being sold. So the buyer wants more equipment. I want you to have more goodwill. So this is where the tug of war is. But I can tell you, we always come to an equitable thing. I don't know many selling dentists that really want to do a bad job and give a buyer no write-offs. We're going on to slide 16. The tax ramifications of selling a practice continued. So a C corporation versus an S corporation. Hopefully by now, you all have been in practice a while, and you know if you're a C corporation or an S corporation. But if you don't, a C corporation is one where all the profit is your salary, and we have to take it as salary. An S corporation is one where your salary is not as high as the total profit of the business, okay? And there are differences when you sell your practice between if you're a C corporation or an S. And there's opportunities if you're a S corporation to maybe going to a C corporation before you sell because of a potential of a retirement plan, and we do talk about that when you're getting ready to sell. But the biggest here is that in a C corporation, there was a court case, and it locked this particular dentist into a situation I would never want to have. They actually had an employment contract and a covenant not to compete with their own corporation. And therefore, the covenant not to compete and the goodwill were stuck in the corporation. And you remember what I just said. If you're a C corporation, all the profit is salary to you. So it means we are going to pay all the payroll taxes on these things. It comes to the bottom line as profit. So really can be really hazardous, and that is the Howard case. And it really is something to talk about. So, handling the allocations, you definitely need a CPA like me that I know about dental practices. So we're going on to slide 17. I'm going to give you a little example. Okay, so let's take a look at this price. And remember, way back when in this case study, the very beginning, we talked about the doctor who had a practice and he wanted to sell for $600,000. So here we are. We've got the practice and the selling price is $600,000, and they got a buyer. Art did a fantastic job. They got a buyer for $600,000.
Thank you, Monica.
You're good. You did a good job for him. So here's how we've allocated it: $100,000 to dental equipment. We've got $20,000 to furniture and fixtures. We've got $10,000 to dental supplies, $5,000 to covenant not to compete. And I'll tell you, for dental supplies and covenant not to compete, those are very standard. If there is anything in allocations, commonly seen prices for those things, because really, dental supplies are 1 month of supplies. That's all you should really have on hand. They can deliver in 2 days, for goodness sakes. You don't need a lot of supplies on hand. Covenant not to compete, it's just enough to let you know, hey, we know it's there. If you're retiring, you shouldn't be anywhere near what you've sold, because that's not fair to the buyer. And then you can see my favorite category, goodwill, $465,000 of the $600,000. That's what I like to see.
I want to make one point again. I'm not the tax person here, but from a broker's perspective, many of the brokers out there provide a contract as part of their services. I do not, because to me that's the unauthorized practice of law, and I don't have a law degree. And in those contracts, the broker will put an allocation. So then the broker provides the contract to the buyer and the seller, and then they come to Monica. And Monica looks at this, and they say, well, the broker made the allocation. And Monica looks at the allocation and says, what? Why didn't you talk to me about this? So a broker should never, ever, ever, ever get involved in the allocation. When I do allocations of the purchase price, I will call the two CPAs. I'll find out who they are. I will introduce myself. I'll say, hi, I'm Art Wiederman. I'm the broker for the seller, and I'll make that point in a second too. And we need you and the buyer's CPA to get on the phone. Here's each other's phone numbers. We need you to talk, and we need you to allocate the purchase price. One thing I want to make a point too is and I didn't when I was talking about brokers, is that in the state of California, it is legal in order to be a broker, you have to get a real estate license. You either have to be an agent or a broker. My partner, Dr. Phil Potter, and I are both California real estate brokers, and we are allowed by law to be what's called a dual agent. We could theoretically represent both you, the seller, and the buyer. And to me, that is the world's biggest conflict of interest. We are strictly a seller representative. If a broker is a dual agent broker, and many of the brokers that have been in business for a long time have done that, you just have to have that conversation with them and say, how does that work? So that's another thing to take a look at. But again, a broker should never, ever, ever get involved in the allocation. All right, we're getting down. I want to leave some time for questions. I want to touch a little bit, I think, on financing. And if we have anybody out there who's got some questions about selling to an associate, Monica can probably arrange a phone call with that. I'd be happy to have that conversation at another time, but I want to leave time for questions. Financing, okay, there are dental specialty lenders. There are 4 or 5 of them that are out there. I can mention them by name: Wells Fargo, U.S. Bank, East West Bank, Bank of America, SunWest Bank. There are some of them out there. If you notice the names I mentioned, there are three, and Citibank also does it. 3 or 4 of the biggest banks in the country. Dentists are very good risks and always have been. So they will generally lend up to 90% of the sales price on a good practice. A buyer who has a credit score of less than 670, 680 probably need not apply, because they're probably not going to get a loan unless they got a guarantor or a bunch of money to put up. Banks are requiring, as I mentioned earlier, seller carrybacks. Right now the rates are really, really good. Some of the banks out there are offering rates for really solid practices with really good buyers who have really good credit. Some of them are offering them the high 5s and low 6s is what we're seeing. The bigger practices might have a little higher rates because it's a bigger payment. It all depends on the practice and the buyers. 100% financing, if approved, is available. If you've got a good profitable practice and we can find you a buyer who's got some money to put down, we can get a 100% loan. They're out there. Talked about the interest rates. We always encourage buyers to get pre-approved so they can move on a practice. And one of the things you want to do, and this is another conversation, because if you're working with Monica as a CPA, there's a very good chance that she's doing monthly financials for you. Make sure you check with Monica and double check how much debt do I have in the practice, because if you are working, as Monica was talking, on your retirement plan, and you're planning on $500,000 net, but you're not really sure exactly what the debt is on your practice, you might get a big surprise, because the lender's going to run a lien search, and they're going to figure out that this debt is secured. Now, they're only going to pay off the secured debt, the debt that's with a bank, the debt that's secured by equipment, but they're not going to pay off your credit card debt, because that's unsecured debt. So that's something you want to make sure when you're talking to Monica about your financial planning. Make sure and Monica's going to bring it up to you because she's a real sharp CPA, and she's going to say, now, doctor, you remember that you got $300,000 that you owe to Wells Fargo on your equipment loan that you did 4 years ago. And so that's something that's really, really important. Go ahead, Monica.
So, Art, what I've seen in a few deals that have come by is that the buyer wants a certain amount of money, and the bank comes up, or the seller wants a certain amount of money, and the bank says, well, that's great. This is all we're going to lend. Right. And so if the seller wants to sell for that, they're going to have to take a note. So, are you coming up against that a lot?
Yes, that's what we were talking about that a little earlier, Monica, and you're absolutely right. They are coming up against notes, and we are seeing more. So we're seeing where the bank's going to say, okay, buyer put down 5 or 10%. Will seller carry 10, 15%, and we'll loan maybe 75 to 80% of the price. Because, again, you want to get the best price for your practice, and if you find a good buyer and they're willing to pay you for it, that's fine. A lot of buyers are thinking, well, if the bank's only going to loan this, is it really worth that? And the answer may be no, because fair market value in this life for anything is what a willing buyer is willing to pay a willing seller. That's what fair market value is. It's not what a bank says. It's not what Art says. It's not what Monica says. It's what that is. On accounts receivable, the accounts receivable are generally not included in the price. You can either sell the accounts receivable at a discounted amount, which we generally don't advise, or basically you keep the receivables and you have the buyer's staff collect them for you at usually a 5% service charge. We've seen lots of discounts of receivables, and that's you can generally make more money by basically having the buyer's staff collect your own receivables. All right, I think, Monica, we're getting pretty close here to the end. We have about 5 to 10 minutes left, and I guess now we're going to take some questions.
Yeah, there's a few more in here about, working back, selling to your associate. And as Art had mentioned, I think that that's something that we can have a conversation about at a later point if that's really what you want to do, because there's a lot of issues to do that. So, Jeff,
that's a half-day course.
Yeah, there's a lot of things. But, Jeff, we're going to turn it over for you for questions.
Okay, thanks, Monica and Art. We've opened up the line, so if you have a question, you can go ahead and just ask your question. And, Monica, we do have 2 or 3 questions that have come through the webcast, and I can ask those if we don't have anybody on the phones that has a question right now.
Okay.
And I don't hear anybody. So we have a doctor from Seal Beach that asks, how about an installment sale where the doctor holds the note, say 7% for 10 years, and the selling doctor hangs on for 2 years on a part-time basis to transition the patients properly?
Well, I'll give you my opinion on the installment sale, and Monica, why don't you go ahead and jump in. Installment sales are really scary to me. The reason they're really scary is because, I don't know what the verbal skills of the buying doctor are going to be. And once you set it up as an installment sale, if the buyer runs your practice into the ground, you're not going to see your money. We see very, very few of these. Where we really see them, Monica, and maybe you experience this, is in family sales where the mom or dad is a dentist and they're selling to son or daughter. Then it's like, well, I think we know these people and I think they're going to pay us and it's part of a long-term retirement plan. But I would be very, very careful about taking one of my main assets in life and selling it to someone and hoping they're going to be able to run this practice for 7 years and not lose anything. Now, historically, the buyers are going to retain 85 to 90% of the patients, because you know as well as I do, folks on the phone, that you've got patients that drive from Palm Springs to see you. You've got patients that come from all over the place. When you sell after 30, 35 years, you're not going to retain those folks. You're going to have people who are going to say, okay, I don't like the new doctor. I don't like the way he or she talks. I don't like the way they communicate. I don't trust, and they're going to leave. So, but the fact is, that's normal. Do you really want to trust this buyer who you probably don't know that well? Because remember, when we as brokers bring you a buyer, that buyer is someone that you're going to meet 2 or 3 or 4 times. You don't know this person, and you're going to entrust them to make the payments. And what if they stop? Then then you're retired. You're on the cruise ship, and you're out there on the golf course, and you get the call, so I'm not paying you anymore, and you've been depending on that income to live on. Now you got to go back in and get your practice again, which is now in shambles. So, Monica?
No, I'm all for that. I agree. And the question was, what if I stay on 2 years to transition it and to make sure that everything runs smoothly? Well, first of all, will the buyer have enough money? Is there enough money for 2 doctors in that practice?
Yep.
Okay. First, you have to look
That's
at that.
That's a huge point.
If it was a 1-doctor practice, there's no money for him to be paying you to work back and transition this thing. If you think you're going to do it for free, you're not going to do it that long for free. And the other is, I don't like the tax aspects to it, because guess what? You got an installment loan that goes over multiple years. Look what's happening to us. 2013, we're going to have tax rate changes, and they're going to go up. They're not going down. So now you've got money that's going to be paid out over a period of time. Sure, you're getting a 6% return on that, but now your tax rates went up. So where you could have got it all at one time, paid lower taxes on that, now you're going to be paying higher taxes on it, and you're going to pay taxes on that money that you received, too, over that period of time. So I think it's a real risky move to take the whole note on all of it, because ultimately something could go wrong, and I've seen it. I've seen it where they stop paying, and then that was your retirement. Well, that part of your retirement just went away. Now how are you going to recover that money? So I think it's risky.
All right. Jeff, you have your next question?
Yes, same dentist from Seal Beach. 80 to 95% sounds good. What about a partnership situation where one partner wants to bail out before the other?
One partner is buying out the other partner?
I think it wants to bail out before the other.
Oh, wants to sell before the other, and the other doctor's not going to probably buy him out.
I think that's the question.
Yeah, I mean that gets a little more complex. If each doctor, in essence, has independent patient basis, then it's not that hard. With that one, we're going to see maybe a little bit lower, and here's why. Because the problem we're going to have is that both doctors know the patients of both doctors.
Almost over.
They'll know each other because they've been practicing together for a long, long time. And there is a possibility that some of those patients could go over to the partner that's staying. So we do see some discounts in the price for that situation. But there's a lot of dynamics that get involved in that I wish I had the time to talk about. But I would say that valuation might be a little bit lower just because of the possibility that there could be some attrition from the buying doctor over to the other partner who's staying. But we still see them at or near those levels.
Great. And the last question, I think, came when we were talking about cleaning up the balance sheet. What's considered high net profit?
Well, high net profit would be a practice where your overhead is in control. In a general practice, if you can get your overhead to 50 to 55%, that's a well-run general practice, and you're going to have high net profit. So what we have to look at is making sure that your overhead is in a reasonable rate. And there's things that can cause that to be a little bit different.
And one of the things, doctors, that you might seriously consider thinking about doing if you have a 1 to 3 year time frame is bring a dental management consultant into your practice. Let that consultant take the practice apart and put it back together and say, listen, I'd really like to crank this thing up. I'm doing 600. I sat down with Monica, my CPA and trusted financial advisor, and she's telling me that I'm a little light on my retirement funds. So I'd like to see if I can get a little more money. So you bring a consultant in, and what can we do? What can we do about helping that practice to grow more net profit? Because Monica, as your CPA will tell you, if you generate an additional dollar of revenue, you don't have a lot of additional expense. You have, pretty much lab and supplies. So if I can increase my practice by $200,000 or $300,000, and I've seen this. We have sat down as the broker. Doctor will call Dr. Phil Potter and I, and we'll sit down 3-4 years before, and we'll look at the numbers and we'll say, hey, doctor, your profit is low. We're going to have a real difficult time getting you the price you're looking for. But we can identify with the help of one of our management consultants that we refer to, and Monica and I, we work with a lot of the same people, and we know them and stuff, and she can certainly refer you to a good one and take a look at the numbers and say, listen, we need to get this thing up, Joe, or Gene, we need to get this practice up $300,000-$400,000 next 3-4 years, so that when you sell it, number one, you're going to enjoy the fruits of the extra profit over the next 3 or 4 years, and number two, you're going to get more for your practice. And it's going to be easier to sell because that buyer may be looking at 2 or 3 or 4 practices, and if yours has got a higher net profit, they're going to make more money.
So when it really comes down to it, we're looking at not only the bottom line, but the top. And doctors, when you're 3 years out to retiring, you have already semi-retired. And so your numbers have consistently started to go down on the top line. So absolutely, I agree with Art. Let's get in there. Let's make sure we're getting production done, because we do want the top number to increase, which really does affect coming right to the bottom if we can get all that overhead in line.
Monica, and Art, even though we said we were going to end at the bottom of the hour, we've extended the call, so if you need to take more time, that's fine.
Let me make one more point. We were talking about valuations, and the doctor was asking about valuations. Banks are looking also at increasing versus decreasing revenues. A lot of the banks will not lend anywhere near as much with decreasing revenues. So if you've got a practice that's going down steadily, a buyer's going to say, wait a minute, what's going on? What's going on here? Whereas if the practice is increasing steadily, we know it's a well-run practice with good staff, good verbal skills, good new patient flow. So that's a big deal there. So Jeff, do we have any more questions?
No.
Anybody
I think
on the line?
That's it. No phone questions, but that's all that came through the webcast.
Okay.
All right. Well, again, I want to thank Monica for the opportunity to present this information to you. We'd be more than happy to help you in talking to you about your transition under no obligation. And again, I have great respect for Monica. I've known her for many years, and she's an outstanding CPA. You're all in very, very good hands, and it's an honor to work with her and what she does. So if you have any questions, we'll be happy to help you meet your goals and dreams and improve the quality of life and by moving on to the next phase of your life. I do want to make one more point in closing as the broker, and we get into some of this too. Doctors, the financial part of this is really important. I mean, it's money, it's your retirement, but you really need to be thinking about what are you going to do on the other side. Because remember, all you've ever known for 30, 35, 40 years is go to the office, look at the schedule, pick up my handpiece, and start working. You don't know anything else because most of you, that's been your only career. And now you have to think about, now I'm not going to go to the office. What am I going to do? One piece of advice that I do have for you is the dental convention is going to be the first weekend in May. Go walk around the dental convention. There are hundreds and hundreds of vendors, but don't go to the booth where you're looking at impression material, okay? Go to the booths that have companies that might employ another dentist. Go talk to the folks at Henry Schein and Patterson and Pearson and all that stuff. Talk to them about, well, I've always wanted to get into sales. What does it take to get into your company? What can I do working there? Go to the labs. Talk to them about that. Look at all the different opportunities. And I've actually sent sellers to the convention. I've had 2 or 3 that have actually found their second careers. And in fact, my partner, Dr. Potter, he found his second career after he was a practicing dentist for 33 years, working as a dental practice broker. So everybody does something differently, and that's something you need to do. All right. Well, again, thank you very much, folks. And I think we're going to throw it back to Jeff.
Over to Jeff. Yep.
Well, great. We want to thank everybody for being on tonight's call. Art and Monica, if somebody has an interest in taking the next step, having a personal conversation, what's the best way to get in contact with both of you?
Well, I think the best way for the next steps is for them to call me. Let's chat about, where they are in the process, start looking at if this makes sense for them right now. And then if there's more questions we can set up a conversation with either Art or with Phil and chat about what the next steps might be. Let's start with me. Let's start with, are we ready? Have we thought about all these things? And just see if our game plan makes sense. So that would be the great place to start.
Well, great. Art and Monica, thank you very much for being on the call tonight. This is fantastic information. Thank you, doctors, for being on the call. And we'll wrap it up. If you are listening to the replay, you can get a hold of Monica at her number listed on the replay page. And you have been on the webinar titled The Financial Aspects of Dental Practice Transitions with Monica Rebella, CPA, and Arthur Wiederman, broker. Thanks again, everybody. We'll talk to you soon.